Given the lack of visibility on growth capital for public sector banks, loan growth expansion for mid-sized public sector banks could moderate to a CAGR of just 8% over FY16 to 19, which would be bare minimum to generate sufficient spreads that can absorb the expected operating credit cost over this period. We also expect a decline in a loan book for few of the banks. NPA aging and devolvement of unprovided, unfunded exposures to some large corporates would keep up the pressure on profitability, which in turn could impact the coupon servicing ability for these mid-sized banks. However, our support floor for public sector banks remains intact at AA-, as we expect bailout costs to be manageable at around rupees 85 to 100 billion and even under a stress case scenario. The downgrade on United Bank's AT1 instrument reflects the deterioration in the bank's standalone credit profile. The rating also reflects, in our assessment, a heightened risk of coupon deferral led by continued pressure on profitability, which is coupled with a negative revenue reserve. Over the last few quarters, the bank's profitability has seen impact of lower loan growth as well as increasing credit cost. We expect NPA aging and non-funded exposure to stress corporates to keep profitability in FY17 under pressure. Our downgrade on UCO Bank's long-term issuer rating reflects the consistent drop in its share of systemic assets and liabilities, mirroring the deterioration in its asset quality and continued weakness in its funding profile. Following the lifting of sanctions on the India-Iran bilateral oil trade, bank has seen a sharp drop in its current account deposits. In FY16, the current account book declined by 23%. Even on a standalone basis, bank's profitability and capital buffers appear weaker compared to its peers. However, we expect continued support from the government and therefore rating outlook at the revised support floor remains stable. Indian Bank's rating reflect the bank's ability to consistently maintain above average capital ratios and its strong liquidity profile compared with its peers in the AA rating category. Even on the profitability front, Indian Bank continues to perform better than most of its peers. In FY16, bank delivered an ROA of 36 bps compared to a loss reported by most public sector banks. CET1 ratio for the bank is at 11.7% in FY16, which is well above peer median of 8 to 9%, even when the government has not infused any capital in FY16. We expect strong capitalization clubbed with the forecasted internal accruals to be sufficient to drive a double-digit loan growth over FY17 to 19. The affirmation of ratings on Dena Bank continues to reflect our expectation of support from the Government of India, driven by its majority ownership in the bank, its moderate systemic importance, with a market share of around 1.2% in advances as of FY16. The bank has a third largest network in the state of Gujarat with a pan-India deposit market share of around 1.3%. The rating on the hybrid capital reflects bank's standalone credit profile, its ability to service coupons, and its relative equity requirement over the Basel III transition period. Affirmation on Vijaya Bank's rating reflects our expectation of support from the Government of India in view of its moderate systemic importance. It continues to be the fourth largest bank in the state of Karnataka. In FY16, bank received an infusion of rupees 2.2 billion from government as a part of the Indradhanush scheme, which took the government stake in the bank close to 70%. We estimate bank's capital requirement of rupees 17.25 billion under the Basel III transition to be critical.